Hello everyone, and welcome back. Thank you so much for being here today. In today's video, I'm going to share an in-depth look at the state of the commercial real estate market in the first quarter 2024. We'll examine key trends and data points across office, industrial, multifamily, and other sectors to understand how the market is evolving in the current economic environment. If you find this analysis useful and informative, please show your support by giving this video a like and sharing it with others who may be interested. And if you haven't already, be sure to subscribe to my channel so you don't miss out on future market updates and insights. I really appreciate you taking the time to engage with and spread the word about my content. Let's start by taking a look at the office market, which continues to face significant headwinds in the post-pandemic landscape. According to data from Commercial Edge, only $5.4 billion in office properties traded hands nationwide in Q1 2024. That marks a 17% decline from the same period last year and is dramatically lower than the $18.9 billion in office sales recorded just 2 years ago. Diving into some of the key office markets, Washington, D.C. saw the highest sales volume at nearly $1 billion, though the sale of the Market Square property highlights the overall downward pressure on valuations. While Los Angeles and other major markets saw office sales plunge over 60%, new office construction is also slowing dramatically, with less than 3 million square feet breaking ground in Q1 out of the 87.9 million square feet underway nationally. Life science hubs like Boston and the San Francisco Bay Area are responsible for a disproportionate share of the national development pipeline. As companies continue to embrace hybrid and remote work, and economic uncertainty weighs on leasing and investment activity, the big question is how low will office values go? And how much pain might that cause for owners, lenders, and local governments reliant on those property taxes? While some opportunistic investors, like Yellowstone Real Estate, are betting on distressed office assets, the overall market is still searching for a bottom. I believe we're likely to see prices reset even lower as more struggling properties trade hands or get handed back to lenders in the months ahead. But I'm curious to hear your take. Share your thoughts on where you see the office market going in the comments below. Of course, any discussion of commercial real estate has to consider the interest rate and economic environment. While there have been signs that inflation is cooling, it still remains stubbornly high. The Fed's preferred PCE inflation gauge rose 2.7% annually in March. As a result, the Fed has signaled that interest rate cuts are unlikely in the near term. In fact, some economists speculate the first rate cut won't come until December or first quarter 2025. This higher for longer interest rate environment will continue to weigh on both property values and new investment activity. It also has major implications for the wave of maturing commercial real estate debt that will need to be refinanced at higher rates in the coming years. Moody's is projecting that office values could plunge 26% through 2025, which could lead to sizable losses for banks with high concentrations of CRE loans. In contrast to the challenges facing office and some other sectors, industrial real estate has been a relative bright spot. The shift toward e-commerce has fueled robust demand for logistics facilities and last-mile distribution centers. Chicago has been a major beneficiary of this trend, thanks to its central location and transportation infrastructure. The market notched $435 million in industrial sales in the first 2 months of the year, while its 11.4 million square foot construction pipeline is the largest in the Midwest. To put that in context, Chicago industrial sales in the first 2 months of 2024 were nearly 4x the volume recorded in the same period last year, and its development pipeline is 10x larger than it was a year ago. Nationally, industrial vacancy remains tight at 5.2%, and despite delivering a record amount of new supply in recent years, rents are still trending higher, though there is considerable variation across markets. Switching gears to multifamily, we're seeing a notable slowdown in new multifamily construction. Multifamily starts plunged nearly 44% year over year in March 2024. This comes on the heels of a surge in multifamily development over the past 2 years. But with increasing economic uncertainty and a huge wave of new supply set to deliver, developers are starting to tap the brakes. In California, one of the nation's largest apartment markets, plans for new multifamily projects fell 22% in Q1 compared to a year ago. The roughly 9,000 units permitted marked the lowest quarterly total since 2014. Despite the construction slowdown, the pipeline of apartments underway should still put downward pressure on rents in many markets as those projects deliver. After soaring by double digits in 2022, rents are now beginning to decline modestly in some of the hottest markets. Ahead, finally, I want to highlight the financial distress that is increasingly evident across parts of the commercial real estate industry and the economy more broadly. Fitch Ratings noted that corporate defaults are on the rise amid high leverage and looming debt maturities. And a number of retailers have already filed for bankruptcy or appear to be on the brink of restructuring. In the commercial real estate market, Blackstone made headlines by handing back the keys to 1740 Broadway, a major Manhattan office tower, after defaulting on the property's $308 million CMBS loan. Meanwhile, in the retail sector, the $200 million New York Social Equity Cannabis Investment Fund, which was supposed to provide startup capital to cannabis entrepreneurs impacted by the war on drugs, has run into trouble. The program relied heavily on debt from a Chicago private equity firm that stands to reap substantial benefits while potentially leaving taxpayers on the hook. I think these stories are canaries in the coal mine for growing distress ahead. As the economy slows and lending conditions tighten, more property owners will face tough choices. And with $1.5 trillion in CRE debt maturing over the next 3 years, expect to see a wave of defaults and foreclosures pick up steam. Well, that about does it for today's market update. As you can see, the commercial real estate landscape is shifting rapidly and faces no shortage of challenges. But there are also compelling opportunities for well-capitalized investors to acquire high-quality assets at attractive valuations. The key is to stay disciplined, focus on the long term, and be ready to pivot as conditions change. Hopefully, this gave you a sense of some of the major themes and factors I'm watching in 2024. Let me know what other topics you'd like to see me cover in future videos. And as always, if you found this informative, please give the video a like, share it with your network, and subscribe if you haven't already. Thanks again for tuning in, and I'll see you next time.